This is total growth investing, where price growth is not enough. Dividend growth is not enough. We want to find stocks that grow in both of these categories. And if we can find them, we can beat the market. This series of videos will be doing a basic review of the top stocks on my total growth investing ranked watch list. I have 673 stocks on that list, and I want to focus on the top 10. Everybody does stock analysis a little bit differently. Here's how I do it and what I look at. I look at first impressions. I look at the stock price. I check whether the company is a household name, and if so, where and for what purpose. I look at market capitalization. How big are they? How big in their market are they? I look at what sector and industry they're in. And then I do a basic surface analysis. I look at price growth, dividend growth, dividend history over time, dividend yield and how it has changed, yield on cost, and total return. I can also do a deeper analysis. Earnings per share, adjusted earnings per share, operating cash flow, debt loads. I'll look at the revenue and margin. I'll check fair value based on these measurements, and then I'll look at estimates over the next couple years. The next stock that I want to review is UnitedHealth Group. UnitedHealth Group was originally founded in 1974 by Richard Burke. The original name was Charter Med Incorporated. It was founded in Minnetonka, Minnesota. In 1977, UnitedHealth Group was formed as the parent company. Many acquisitions and mergers later, UnitedHealth Group is now the largest healthcare company in the world by revenue. In 2019, the revenue was $242 billion. They have four major divisions: employer and individual, Medicare and retirement, community and state, and a global division which covers 6.2 million people in 130 countries. The first impression that you'll get when you look at their stock is their price. It's $311.85 today. That's very high. The dip due to COVID-19 was their low point over the past 52 weeks. But they've recovered completely and they're now at an all-time high. Are they a household name? Yes, absolutely. They cover 45 million people around the world. The market cap, $282.69 billion. And the sector, healthcare, managed healthcare. Their price growth has been spectacular. There's no other way to put it. From less than 50 at the beginning of the decade, this is just a 10-year history, they are now up to 311. Here's the COVID-19 dip, here's the recovery, and they're at an all-time high. Their dividend history, again, fantastic. They started paying dividends in 1990. They were annuals. Then they switched to quarterly in 2010. They've grown them every single year. Their next dividend, which was announced on June 2nd, is for $1.25 per share, which is a 15.7% increase from their prior dividend. The ex-dividend date, June 19th. For dividend yield, right now, it's about, 1.63 forward yield as of right now. 1 year ago, it was 2.06 if you bought it 1 year ago. If you bought it 3 years ago, 2.83, and 5, 4.16. That's not the end of the story. I took this graph out to all. If you originally had held the stock when they first started paying dividends in 1990, you would currently be getting 400% return. As far as total return goes, I took this out to max. $18,219.63. The S&P pales in comparison. Let's take a closer look at those numbers. On Seeking Alpha, let's go to Momentum. Their 10-year total return, 1,041.05%. Let's look at that in graph form. Here's price versus S&P and total return versus S&P. This is just over 5 years. Here's over 10. And here's the max. Anybody got a time machine? This is the difference between their price growth and total growth, including their dividends reinvested. Over 5 years, over 10 years, over the maximum. 3,000% difference. Here's that price and volume graph. Let's take it out to max again. Here's the zero line. Let's look at dividends. They're currently paying 1.68%. Their payout ratio is nice and low at 30.81. Their growth rate has been fantastic. Let's take a look. Over 20% every single year. These are compounded annual growth rates. There's that yield on cost again. For 5 years, for 10, 20 years, and all, which we've already seen. Let's do the deeper analysis on dividend stocks.cash. This is UnitedHealth Group's record. They have a couple awards here. Dividend Bunker distinguishes a stock paying secure dividends. Criteria: increasing dividends since at least 10 years and yearly dividend growth within the last 5 years at least 5%. Dividend earning stability of at least 0.8 and dividend stability of at least 0.8. The lightning bolt is Dividend Sprinter. Distinguishes a stock which strongly increased dividends in the last year. Criteria: yearly dividend growth within the last 5 years at least 10%. Earning stability at least 0.8. Dividend stability at least 0.8. And earnings rocket. Distinguishes a stock with high increasing earnings over the last years. Criteria: yearly earning growth within the last 5 years at least 10% and earning stability of at least 0.9. Healthcare provided, market cap over $300 billion. Lots of data. I want to narrow into stability records. So dividend stability, 0.9. Earning stability, 0.92. Cash flow, 0.92. And revenue, 0.98. Price changes, green across the board. He has the 10-year price change calculated at 927.85. Let's look at the valuation graph. So this is all. They started paying again in 1990. They started paying quarterly in 2010. His data begins in 2008, and this looks like the bottom, or a recent bottom, right after the Great Recession. So let's narrow our data to just show the fair value based in this time period. And let's just show the last 10 years. So I'm going to hide everything and bring it back one at a time. Earnings per share is the green. Adjusted earnings, which removes one-time expenditures, is the brown. Operating cash flow is the yellow. Let's bring in the fair values for those. Fair value based on PE, based on adjusted, and based on cash flow. Based on the fair value numbers, it looks like that 311 is overvalued right now. The estimates over the next 3 years, over the next 2 years, this is December 2022, don't show that the price is likely to rise above where it is now. That means to me that it's not a buy right now, not until the price drops a little bit to bring it closer to fair value, because we want to sell someday in the future. And we can only see estimates out 2 years, and I don't want to lose 40. So if we put 1,000 into it and it drops down to fair value based on earnings per share, we'd lose 40, which means for right now, this is not a buy for me. But do you really think it's going to go down? I'll leave that question up to you. Thank you for watching. If you liked this video, please click the like button and subscribe to the channel. I'll be doing more reviews like this of my top-ranked total growth stocks over the next few weeks. And I also have some guests planned with other ideas that you can use to beat the market over the long term.